Okay, this is Chapter 5, Time Value of Money, TVM, as it's often labeled. This is an extremely important chapter. It's a chapter that the material will show up in the rest of the course. You're going to need to know this intuitively. You're going to need to understand this material rather than memorize it. It's going to be impossible for you to try to do the problems that I'm going to show you through memorization. You're going to have to understand it to be able to work the problems. In this video, I'm going to cover future value of a lump sum, symbol just FV, the future value of an annuity meaning a series of equal payments. Then we're going to look at the present value of a lump sum, and a lump sum is simply a single payment. And then a present value of an annuity. And then we're going to look at some miscellaneous items related to this. For example, we'll be looking at nominal interest rates, effective interest rates, effective annual rates, and then we'll get to amortizing loans such as mortgages, student loans, auto loans. It's an extremely important chapter, not just for this course, but in the real world. The real world works with the time value of money. The financial world, the banking industry, the insurance industry, the stock market, the bond market, the business world in general works off of the time value of money. And having an understanding of it is extremely important for a business degree. So with that in mind, let's start right here with the future value of a lump sum. Best way to introduce the material is to give you an example. Okay, so here we have an example. Suppose you deposit $1,000 today in a CD. Okay, certificate of deposit with a 1-year maturity. A CD is basically you're opening up an account with a bank or a savings and loan or a credit union, and you plop the $1,000 in there. It has an associated interest rate. In this case, let's say the interest rate is 10%. I use a pretty high interest rate only so you can see visually the magnitude of the interest compounding. Today's world, CD rates are much lower than that. So the question is, how much in 1 year is this worth? So we basically have a maturity of 1 year. You deposit $1,000. It grows at 10%. It's really the growth rate of the balance. We're not going to withdraw anything. With CDs, you deposit the money and you just leave it in the account until you withdraw the entire amount the CD expires, terminates. So how much is it worth in 1 year? Well, it's 1,000 times 1 plus the interest rate in decimal form means it's $1,100. And with $1,100, you're going to get your $1,000 principal back, and $100 is associated with interest income. Now, the next question is, what happens in 2 years? Well, you take this $1,100 and then you multiply it by 10% because money compounds, it snowballs, and you got $1,210 after 2 years. Then the question would be, well, what happens if it was 3 years? Well, 1.10 times 1.10 times 1.10 equals 1331. So after 3 years, you get your $1,000 principal back, and you're going to get $331 in interest income. As you can see, the interest is accumulating over time. Now, there is a general formula for this, and the formula looks like this. Its future value equals the present value times 1 plus I to the n power. Okay? And so what this is the present value. You're going to have to get comfortable with these terms because you're going to see them throughout the semester in this chapter. Present value is the amount of money that you have today. What is the amount of money that you have today? What is it worth? I is the interest rate specified on an annual basis. N is the number of years, compounding periods. In this case, it's years. And then what pops out of the equation is the future value. So coming back to here, the $1,000 was the present value in each one of these cases. And then we compounded it over n equals 1, n equals 2, n equals 3, and so on. So what happened was, let's do this example. We took $1,000 and we took 1.10 to the third power, and we will come up with 1331 as the future value. And that's not so bad. Now what we need to do is understand how to compute this on a calculator, time value of money calculator, like I have right here. Many, like I said earlier in an earlier video, many of your calculators, even the big ones, they may not be explicitly a financial calculator, but they have a mode somewhere in there, a mode that does time value of money. And so what you need here is, look carefully, time value of money mode. A calculator with time value of money means you have an N for the number of periods, you have an I/Y is the interest rate per period, right, per year. And that's this basically. The calculator is calling it I/Y. PV is present value. Payment, in this case we have no payments. We're not there yet. We don't have an annuity. So the payment equals 0. And then a future value, FV. So you should have somewhere in your calculator something that looks like that. It'll be extremely helpful. It's not absolutely necessary, but when you get done this, you'll realize that you really need a financial calculator. It'll help you significantly in the course. Okay, so now let's actually hit the calculator buttons and come up with the, let's do this, future value equals present value times 1 plus I to the n, and we're going to go over this example. 3 equals 1331. So let's start it up. Turn on the calculator. And by the way, when you turn on your financial calculator, I don't know if you can see this. It may not come out too well in a video, but you need to make sure that you have, one, you have the right number of decimals going across. If you have only 2 decimals to the right of the two digits to the right of the decimal, you probably need to expand that. And the way you do it is you hit second format. So you hit the second button, get in out of this mode. See this yellow button right here? You hit the second button, and the format is where the period is, right down here. So you hit second format, and then it'll say DEC for this example. DEC means decimals. Right now I have it set for 5 decimals. If I wanted to change it to 7, I'd hit 7 and then enter. And then I have 7 digits to the right of the decimal. Okay, that's far more than enough. 2 is not enough in this course, so set your calculator so that you have at least 4 digits to the right of the decimal, at least 4. One other thing, when you get your calculator, if it came right out of the package and you haven't used it before, you want to make sure the payments per year, P/Y, is equal to 1 in our calculations. And the way to do that is you hit, in this case, you hit second, the yellow button, second, and it gets into the yellow mode, so to speak. And you hit P/Y, and if you can see that on my calculator, I'm not sure if you can. You can see that what you're seeing is P/Y equals 1, and then that goes over 7 decimals because I just turned it to 1, 2, 3, 4, 5, 6, 7. I just turned it to 7 decimal places to the right. Okay, so you want payments per year to be 1, and that will help you significantly here. Okay, so we got that out of the way. You got enough digits to the right of the decimal, and you have payments per year 1. Now you're ready to begin this calculator exercise. So we want n equals 3. So you hit 3 And then you actually have to do it backwards in some cases, and you'll have to fiddle with your calculator till you get comfortable. But you hit 3, and then you hit N, and that's sufficient to get it in there, 3N. That means N equals 3. Then you're going to want to put in 1,000, and you put in 1,000. I'm going to type in 1,000, and then I'm going to hit present value. So I typed in 1,000, hit present value, and it'll tell me that I have $1,000 present value. Okay, so I got that out of the way. The payments are going to be 0. As I said, this is only a lump sum. There's no annuity. There's no series of payments. So 0 equals payments. So I'm going to hit 0 and then payment here. And I hit 0 in payment. And then I need to get the interest rate in there. So then I hit 10. And the interest rate will be put in as in decimal form. So you just, or not in decimal form, percent form. So you just put a 10 in, not 0.10, 10. So I hit 10, hit I/Y, interest rate per year is 10, and it knows that it's a percentage. And then what I'm going to do is I'm going to say compute future value. So at this point I'm going to say compute, which is this button right up here. And then I'm going to hit future value, which is this button here. So compute future value. It blinks, and it gave me a -1331 with 7 decimal places off to the right. Now, you might ask, well, why is there a negative sign? Well, you're going to have to get comfortable with your calculator here. Your calculator assumes that you have cash flows coming in, and you have to have cash flows going out. And if you don't have cash flows going in and cash flows going out, your calculator doesn't know what to do. So it will flip signs around depending on what you input. Now here's the thing: when we input present value of 1,000, we implicitly put that in as a positive number. That means we deposited $1,000 into an account. So you can think of it that way. We received 1,000, and now we can withdraw 1331 out of it. Another way to do it is, and maybe more intuitive for you, would be to put the present value in as a negative number. So if you were to put the present value in as a negative number, out would pop 331 positive. So that means you deposited and you cash flow went out of your pocket, so to speak. You put it into an account, and when all was said and done, you can withdraw $331 out of the account. Positive cash flow, money into your pocket. Okay, so get comfortable with that. Your calculator becomes really handy if, for example, you want to go out many years. And I guess in this case it's not too bad. In this case it's not too bad. Get that out of the way. If you wanted to go 30 years, so N equals 30, I/Y is 10, present value, let's put it in as -1,000, and I'm going to say payment is 0, and then I'm going to say compute future value, and out will pop 17,449 with 7 decimals to the right. Okay, it'll come out positive. You could do that mathematically simply by saying, look, 10,000 or 1,000 times 1.10 to the 30th power equals 17,449. So at a 10% interest rate over 30 years, you're going to make 7,440 more. Now, you're going to earn $16,449 worth of interest, and that's the effect of compounding. That's what you want to take advantage of while you're young. If you have the ability to put money into the market, either bonds or stocks, preferably at your age, meaning under 30 years old, you want to put your money in the stock market. As we'll study, the stock market earns, ballpark 12% per year on average. It has done so over the past 80 years. then you can imagine what happens over the years when as you start depositing money. It accumulates significantly, so then it makes your retirement that much easier. Okay, so that was the future value of a lump sum. Now what we want to do is calculate the future value of an ordinary annuity. Future value, ordinary annuity. And what I mean by an ordinary annuity is that the cash flows come at the end of each period. That means ordinary means at the end of each period. Your calculator automatically assumes that, as you'll see in a little while. But basically, here's the point. We've got to start with a timeline, and this timeline is extremely important to get your head around what's going on. I've been doing this for a long time, and I still need timelines. I find that I don't need them. They're extremely helpful in organizing my thought process on it. So what happens is with an ordinary annuity, you got a series of payments over a period of years. Let's say we got 5 years. So we're going to have payment here, payment here, payment here, payment, and payment. Okay? And so what we want to do is we're going to ask the question, well, how much is, when you have all this money, this first payment here, it's going to, you can use your finger here, this first payment is going to be invested for this year, this year, this year, and this year. It's going to be invested for 4 years. Okay? And then this payment will be invested for 3 years. This payment, third payment, will be invested for 2 years. Second to the last will be invested for 1 year. The last payment doesn't get invested at all. It's a time of 0, so there's really no time for compounding, and so there's no compounding of money with that last payment, but it needs to be included in the calculation. So the general formula for this, if you wanted to put this into a nice neat formula, the formula looks like this. The future value of an annuity for n periods equals your payment times 1 plus I to the n power minus 1, okay, all over, that's an exponent. The n minus 1 is not an exponent, divided by I. That is the general formula for an n period ordinary annuity where the payments, they don't start at the beginning like the first. It was starting at the beginning. The first payment would start here at time 0 today. So we always, when we draw our timeline, we almost always start off today at time 0. And this is the end of 1 year, the end of 2 years, the end of 3 years, and so on. That's the general formula. So let me give you an example working this. So here's the example. Write this down as we go. Congratulations, you just won the lottery. The payout is $50,000 at the end of each year over the next 5 years. $50,000, that's the payment. It's a series of payments. $50,000, okay, at the end of each year for the next 5 years. And 1, 2, 3, 4, 5, right there. Okay, now the problem goes on. It says, since you're currently 60, let's say you're 60 years old, you decide to invest each payment. Okay, at age 65, you hope to retire with a handsome sum from this annuity. Remember, an annuity is a series of equal payments, $50,000 in this case. Assume that the bank will guarantee you a rate of 6%. I/Y, 6%. Okay, N, remember, it's 5, so write down the important stuff here. And then how much money will you have in the bank at age 65? So it's asking you, what is the future value of this annuity over n periods, which is 5. Okay, notice we got 4 of the components that we need. The only thing we're missing is we don't have any present value here, because the present value is 0. We don't really have a present value. It's 0 here. You got nothing today. 1 year from now, you'll get these payments. So you start with a series of payments. Okay, So what's happening is, let's see if I can draw this out here. I'm going to chop off the zeros to make it manageable. And redraw my timeline. So what I'm going to do is, and by the way, you should, if you notice, I try to put the cash flows up top above. You should be systematic, in other words, so that you're organized in putting these timelines together. So here I put 50, 50, 50, 50, and that's where I put my cash flows across the time, across this time series here, this timeline. Now, what I want to do is, I'm going to show you that this formula works. And so this is a nice shortcut formula because, boy, if you had 30 years, you'd have a long timeline on a lot of calculations. So let's see that this works. So let's take this 50,000 and treat it as a lump sum. If you took this $50,000, and you multiplied it by the 1.06, 1 plus that interest rate, and you went 1, 2, 3, 4 periods, it would be worth 63.124. Okay. Now I'm back to this is $63,124. I want to keep it out 3 decimals to the right here. So the first cash flow gets compounded 4 periods at 6%. The second cash flow, 50 times 1.06 to the third, gets compounded 3 periods. That's 59.551. The next cash flow gets compounded over 2 periods, and that's 56,180. Second to the last, 50 times 1.06. You don't really need to put anything here. You can put it to the 1 power, but it doesn't do anything mathematically. 53,000. Plus you need to add that last number. And mathematically, you could just say 50,000 times 1.06 to the 0 power. And anything to the 0 power is itself. So when you add this up, oops, these are decimals here. When you add this up, you get 281.855. In other words, if you win the lottery and you get $50,000 for each of the next 5 years at the end of each period, and the bank will pay you 6%, if you invest that money, it will compound to $281,000. That means you basically earned $31,855. Just subtract 250. This adds up to 250. So you subtract the 250, you made $31,855 in interest income from this. Okay. Now let's make sure the formula works. So here we're going to say the payment, put it in as a 50 here. 1.106 to the 5th power minus 1 over 0.06. And we do that, we get 50 times 5.6371. That equals 281.855. And there you have it. You don't have to go through the tedious calculation here, but the tedious calculation gives you the intuition as to what this big formula does for you and what this formula does. In another video I'll derive this, but you don't need to know how to derive this formula. It's not hard to derive if you know something about infinite series and series in general, but you're not expected to know that. So there we have it. Let's verify it a third way. So when you do this on a test, and you certainly will do something like this on a test, these types of problems, you can do things by hand here the long way. You can have the shortcut formula method here, or you can do it by calculator. And here's what you do for the calculator. N equals 5 All right, plug n equals 5. Let me do that along as I speak. 5n. And then I slash y is 6. So I'm going to say 6 I slash y. Present value is 0. And again, there's no present value. You have no money starting today. So 0 present value. Payment. Now, payment you can put in as a positive or a negative here in this case, and you're going to really have to get comfortable and just be able to interpret when things come out positive or negative out of your calculator. You're going to get positive or negative results. You just need to be able to interpret what that means. It won't be that hard when you know if you know the context of the problem. So the payment in this case is going to be, you can imagine putting $50,000, right, in an account, depositing and asking how much am I going to get back out of that account, and so the future value will be positive. So now you got 4 out of the 5 components. Now the only thing you don't have is future value of the annuity. So you compute future value. Okay, so notice this time we put in a payment, and that payment says, it's telling the calculator that this is an annuity. So put in 0, I got to put in the 50,000, and you can put the negative in there by hitting the plus minus sign, and then I put that in as a payment, and then I hit compute future value, and out pop 281, 854 and 65 cents basically. And there you have it, confirmation that it works, but you got it to the exact decimal in this case. So there you have it, future value of an annuity. So we want to move on now to we're going to move on and to what's called an annuity due, a future value of an annuity due. We're looking at the future value of an ordinary annuity. Remember, ordinary annuity means the payments happen at the end of each period. So you start at time 0 and they go at the end of each period for 5 years. Right? So let me do a comparison. What we want to do is look what happens when we have a future value of an annuity due, which means the payments are at the beginning. So let's look at the ordinary. Five periods, and with an ordinary we just covered it, payment, payment, payment at the end of each period. Now with an annuity due, as it's called, they're sometimes called an annuity in advance. So due or advance starts out same timeline basically, but the payments happen here. So it's as though this whole time series right here gets shifted to the left by 1 period. You still have, in this case, 5. If n equals 5, 5 payments, but they're all shifted to the left, which means you get your money sooner rather than later. And the way to do that, so your calculator is geared and is wired basically to handle an ordinary annuity. That's the default setting. If you want to start getting into annuity due, and we'll do this with both a future value and a present value shortly, is you need to go to your calculator and hit second, get into the yellow mode, hit the second button right there, and then hit the begin button right here. The yellow thing that says BGN. So you hit second, begin, and then second, set. And then you'll notice, so I'll write it out. Second, begin, second, set, and then hit enter. And you will see BGN on your screen in big letters on the left. And you also will see it, not only will you see it, so if this is your screen, I'm not sure if you can see it here, you'll have BGN in your calculator, but off to the very upper right hand corner you'll see a little BGN up in the upper right hand corner. Don't ignore that, because what that little BGN is telling you is your calculator is thinking in this mode. It's thinking this is going on. And if you have a problem that's an ordinary annuity, you're going to come up with the wrong answer. So you want to make sure that you're in a due or beginning mode if you have an annuity due or an advanced annuity. And you can undo this by hitting second set. You can hit second, begin, second, set, and hit enter to make sure it sticks. And you have it. And it'll be in back to the original ordinary annuity. So let me get back to that. I want to get back to a beginning mode. Okay. Now, let me do it by hand, and then I'll show you the trick on how to get to it in a shortcut formula method. So let me show you the hard way of doing it, the intuitive way of how it works, and then I'll get to the formula, which is a bit simpler. One, two, three, 4, 5. We're going to get 50 starting today. So basically, let me read the problem here. It's the same problem, except it's a beginning annuity. So assume you've won this lottery and you get $50,000 per year at the beginning of each year instead of at the end of the year for the next 5 years. What is the value of the annuity at the end of 5 years? So it's asking, what is it worth at the end of 5 years? But the payments are all shifted to the left. And so notice there's still 5 payments. 5 payments, that's important, but they're shifted to the left. But you're asked at year 5, how much is it worth? Well, take this number and compound it. Make it snowball at 6% for 1, 2, 3, 4, 5 periods, 5 years. That is worth 66,911. Take the next one. 50 times 1.06 to the 4th power. 1, 2, 3, 4. And you get 63.124. And you just continue. And you continue. And you continue. And we get 298.766. Wow, that's different than the 281 we got. Remember, we did the 281 back here with an ordinary annuity, but now look, we got an extra 18 grand on this one. So how's that coming about? Well, this is the old story. Is you basically the old conclusion is you want your money sooner rather than later, because when you get your money sooner, ignoring risk issues, you get to compound the money a whole extra period. So you're getting compounding a whole extra period, and you're gaining $18,000 because of that. So all else being equal, you want your payments up front now rather than later. The whole financial world works on that concept, and it's basically the opportunity cost. You rather, it's cost whoever you're getting the money from. This $50,000 you're getting from the state. The state would rather hold on to that money and earn 6%. They give it to you a year early, you're earning the 6% instead of the state. And so if you can get your money early, you get to earn that interest. Otherwise, there's a cost to you in allowing your money to be delayed in payment. So delay in payment has a cost. And this shows up in all sorts of contracts. So you want to buy a phone, or you want to buy a car, and you have to make payments. You can pay for it all up front and pay $25,000 for a car, or you can pay it out over a series of of years, in which case there's going to probably be an interest rate associated with that, and the sum of those payments are going to add up much higher than $25,000. So you rather pay late and receive your money sooner is the way to operate in the business world. Get your money as fast as possible in your pocket, delay payments as much as possible. Especially when interest rates are high, it has a significant impact. Now, okay, so we're at 298 here. Let me show you how to get there mathematically through a formula. The trick is that the future value of an annuity due, which is what we're trying to calculate here, equals the future value of an ordinary annuity, which is what we did a few minutes ago, times the 1.06. In other words, it's as though I am taking the entire annuity here, moving it forward and compounding it one extra period. So it's as though this is the ordinary annuity where the payments are delayed. And if I take those payments and I just compound them by one whole extra period, because I basically shifted everything to, if I shifted everything to the left, then all I need to do is compound it one extra period, so to speak, that whole balance. So I compound that whole balance at 6%. And so what I get is, look, 281.855. That came from the formula I showed you earlier, which is payment times 1 plus I to the n minus 1 over I. So there's your formula. Then you just multiply it 1 plus I, in this case 6%, and you get 298.766. Okay, so that's the trick. Or you can just go to your calculator and make sure that you're in begin mode, and you're going to hit n equals 5, payment equals 50. You can put it in as negative so it pops out as a positive. Your interest rate 6%, present value 0, compute future value, and it'll be the future value of a beginning annuity, and that will come 298.766. Okay, now this future value I think is, especially when you see me map it all out like I did here, it's fairly intuitive. Future money, when you invest money in an account, it snowballs. It just accumulates over time. And that compounding of money, that is the secret to finance, is the compounding of money. And so we need to take advantage of that. And that's where a long horizon for investing. So you start investing if you can. I know it's very hard. When I was in my 20s, I didn't have any money to invest. But I wish I did, because if I had something, it would have accumulated into something huge as I got older. So the point is, if you can, try to save something, even if it's small, because it'll accumulate to something big. And I only went 30 years. If somebody in their early 20s has a life expectancy of well over 80, right now it'd be, your life expectancy is in the mid 80s. It'll be probably much higher in 40 years from now. So the N of 30 that I had earlier for retirement, that's too short. You could probably go N of 50, and you're talking 50 years of compounding. It's huge, huge. Okay, let's go to present value of a lump sum. Okay, so present value of a lump sum. This is not too bad. It's just the reverse. We're rewinding. So you have imagine the snowball accumulates to a large future value. You have a small present value and a large future value. That's how it typically works. Now, what happens if you're given a future value and want to compute a present value? It's basically taking that snowball and rewinding it. So maybe you take a video of a snowball accumulating as you're making a snowman. Think about running the video backwards, and that's what present value is about. So remember the formula that we had earlier was the future value equals the present value times 1 plus I to the n. Now what we're doing, and we solve for future value, what we want to do is solve for present value. So what we do is we divide both sides by this component. So future value divided by 1 plus I to the n equals present value. And so we take the future value, divide it by 1 plus n, you make that future value smaller, and that pops out as the present value. Okay, let's do an example. Okay, 4 years from now, you will need to purchase a new car and do not want an auto loan. The expected price of the car 4 years from now is $35,000. If you decide to invest an amount today that will grow to $35,000 in 4 years, how much do you need to invest today, given that the account pays 4%? Okay, so start throwing the data that's given into, you're going to need an N, you're going to need a PV, so just in general, you need these. You need 5 elements, 5 things to fill in. Well, 4 things to fill in, and the 5th is always the question. So it's asking you, how much do you need today? That's the question. How much do you need to put in the account today? What is the present value? Because you know what the future value is. You need, in 4 years, you need $35,000 bucks. So you can think of that as, you can put it in as negative, and putting it as negative just means you're going to withdraw $35,000. The interest rate is what was the interest rate? 4%. Okay. And in this case, there is no payments. There's no indication of payments anywhere. The payment is 0. You're just putting in a lump sum today that grows to $35,000, growing at a 4% interest rate. So this balance grows at 4%. That's what the interest rate is. And it's over 4 years. So the simple math is the present value. So if you did this and calculated on your calculator, you'll get $29,918. Okay, try that. Actually do that in your calculator. Or 35,000 divided by 1.04 to the 4th power is 29,918. Now, how do I interpret that? Well, I interpret it this way. Drop in, deposit $29,918 today, and in 4 years at a 4% interest rate, you'll have $35,000 to be able to pay for the car. Okay? So you're going to, you can, now it doesn't, you could put this in as a positive and let this come out as a negative. It doesn't matter. You'll be able to interpret, look, you need $35,000, and you're going to need to deposit $29,000 today. So think of it that way. Again, don't worry too much about the signs. For the most part, you'll be able to interpret it based on the context of the question. The question, it becomes a little harder, and you'll see a little later on, it becomes a little harder when you have to put both a present value, a future value, and a payment all in there. You got to make sure you got the signs right then, and I'll show you as the problem when the problem pops up. Now, what happens if the interest rate instead of 4%? Let's say it's 9.2%. Just making up a number, 9.2%. Do the calculations, put in 9.2%, you'll get $22,540%, or $22,540. So you only have to deposit $22,540 to get your $35,000 back out of your account in 4 years. Why? Because your account is growing at 9.2%, a much higher growth rate. So you have to put less money in for it to snowball. Okay? If your snowball accumulates at a 9.2% much faster, your snowball will get to a certain balance by a certain size. You have to start pretty small. It doesn't, basically. Now, if interest rates are really, really low like they are in today's environment, you're not going to get much compounding. You're going to have to put in like $34,000 or more in an account, and it's barely going to grow because interest rates are so little, less than 1%. So you're not going to get much out of your bank accounts. And that's one of the problems with today's environment. In today's business environment, with the Federal Reserve keeping interest rates low, savers and people who deposit money in certificates of deposits, in bank accounts, in money market accounts, they're earning interest rates that are very, very low. They're not getting much. And so there's very little reward to saving, which can have a negative impact on the economy if there's very little savings going on. If you raise the interest rate that banks will pay, there'll be more savings and more loanable funds flowing into the market. Right now, the Fed is basically the one supplying the credit to the markets, and it's not private investors, private savers. Okay, so let's look at a formula now. Let's look. Let me see here. We want to go to a present value. That was the present value of a lump sum I just covered. Let's do the present value of an annuity. Okay. Present value of an annuity, ordinary annuity. Okay, which means the payments are happening at the end. So the present value of an ordinary annuity over n periods equals your payment times 1 minus 1 over 1 plus I to the n. And by the way, I'll give you a formula sheet on the exam. You don't have to memorize these formulas. I will give you a formula sheet. Supply it with you. And the formulas will look just like this, just like I'm showing you. You'll have a financial calculator. It can't be your phone. Your phone is unacceptable as a financial calculator, even though there are financial calculating apps. I know that. I've seen them. But you can't use them, obviously, because you're connected to the world then. But you can bring in a financial calculator. You can have a BA2 Plus or any other calculator as a financial mode. Or, like I said, I keep telling you, technically you don't need a financial calculator. You can get by without one, but it's harder. Okay, let's do an example of a present value of an ordinary annuity. Congratulations, you just won the lottery again. The Lottery Commission gives you a choice. Take an annuity for $25,000 at the end of each year for 5 years, or $100,000 today. So as soon as you see that word today, it tells you you're at the timeline component, at the zero part of the timeline. And so it's telling you, look, there's $25,000 in an annuity payments at the end of each year for 5 years. Okay, so right here, payment $25,000, right? N is 5. The interest rate is going to be, so here's the rest of the question is, what is your decision if interest rates are 6%? So there it is, 6%. So we got 3 out of the 4 we need. Okay, so what else do we need? We have that. We have a present value of $100,000. Okay, so now it's not asking, by the way, look at this problem. It's not asking for a future value. The future value is 0, by the way. So what this problem is doing is it's saying, look, what is the value of this annuity versus the present value of $100 or $100,000? So maybe maybe it's a little confusing. We don't want to put this into the calculator yet. Okay? What we want to do is we want to compare this annuity to this $100,000, which this $100,000, it is a present value term because it's today. You got your choice of getting $100,000 or $25,000 over the next 5 years. Okay, so let's do the calculation and it'll become apparent. So here's the present value of an annuity for n periods. Put a little 5 there if you want. And it's $25,000 1 minus 1 to the fifth over 0.06. And added, this whole thing is 4.212. So this comes out to be 105,309. Okay? So the present value of this annuity that you're getting, okay, is $105,309. Okay? Now, that's the formula. Compare that to the 100,000. What would you rather have today? Would you rather get $100,000 in cash in your hand or getting an annuity that's worth $105,000? The answer is you'd rather have the annuity, assuming away any risk. Say the risk is the same for each. You know, you're getting money from the state, so the state's got to be around in the next 5 years, so you don't have to worry about risk. So you'd rather get the annuity, is what this is saying. So pick the annuity. Now, let's get the intuition behind this stuff here. And by the way, if you plugged in this payment of 25, N is 5, and I/Y is 6%, future value of 0, you will get a present value from that annuity of 105,309. So check that in your calculator. You shouldn't have a problem with that. Let's look at the intuition for a moment. So we're going to have a timeline. It's 5 years, and you're going to get 25,000. Chop the zeros off. I don't want to write them out. And it's asking, what is the value of this annuity right here today? Because the state's sitting with $100,000 and saying, look, I'll give you this or $100,000 right here. What do you want? So we're going to calculate the present value of this simply by taking the present value of each cash flow. So this cash flow, what's it worth today? This is $25,000. 1 year from now is not the same as what $25,000 is worth today. So how do you go about working with that? Well, you take 25 and divide it by 1.06 to the end, one period. So this is worth 23.585. Okay? In other words, if you invest 23,000 at 6% for 1 year, it'll be worth 25,000 in 1 year. Now take this payment and discount it for 2 periods. 25 divided by 1.06 squared, and you get to 22.250. Keep doing this. Keep doing it. And when you add this all up, you'll have 105,309. So verify that you can do that. It's a great opportunity now to stop the video. Make sure you can do these calculations and it adds up to 105. And make sure you can do it on your calculator. Now when you do this on your calculator, don't forget, this is an ending annuity, so flip it out of the BGN, because if you look at your calculator, you're going to see a BGN up in the screen in the right-hand corner. Get rid of that by, say, second begin, second set, and you'll get this out because you want an ending. And when there's an ending, it doesn't say END anywhere on your screen, because that's the default mode. The world of finance assumes that an ordinary annuity is one where the payments occur at the end of the period. Okay, so that was an present value of an ordinary annuity. Now what happens with the present value of an annuity due or in advance? So let's make sure we cover that while we're here. So let's look at the timelines again. So this will be ordinary, this will be due, or advance. Okay, with an ending annuity, you get payments here, as I just showed you. But with a new annuity due, I'm asking what is the present value here for payments that start today. But they have to have the same N. So here's the last cash flow, because that's 1, 2, 3, 4, 5, the fifth cash flow. There's no cash flow right here. So it's asking what is the present value here. Well, the formula for that is the present value of an annuity due equals the present value of an annuity ordinary, that's ordinary, n minus 1. So I should say present value of an annuity due for n periods, in this case it's 5, equals the present value of an ordinary annuity for one less period plus a payment. And let me explain that. Notice, if I was to cover this one payment up with my finger, this annuity, these two annuities, right? This annuity right here is really a ordinary annuity for 4 periods, right? It's an ordinary annuity for not just 5 periods, but 5 minus 1 here. Plus add this last payment, so this last payment right here is coming in. There it is. And this is the present value of this, which is the present value of an ordinary annuity for not 5 periods, but 5 minus 1. 1, 2, 3, 4 periods. Okay? And so that's what the present value of an annuity do. That's the trick to get there. I sometimes call it toggling. You're toggling between an ordinary and one in advance or due. And the present value trick is you add the payment. With the future value, you take 1 plus the interest rate and compound the whole thing forward, just snowball it in one period. Here, you're truncating the series, and then you add this last payment, because this last payment doesn't get any compounding. When you have anything to the 0 power, because the time period is 0 here, there's no time to invest money, there's no compounding, the payment is worth the payment. So there's no time effects on this payment term here. So when you do that, and you put this into your calculator, or let's actually work this before we go any further. So this will be 25,000. See my 4, n minus 1 is 4.06 plus 25,000 gives me 111,627. Okay, 111. Look, you'd rather get your payments sooner rather than later, so it's worth a bit more. You're getting paid, everything's shifted back a year with the annuity, ordinary annuity, but with the present value, you're happy because you get your money right up front. And so it's worth 111. So you get an extra 6,000 out of it, which is good. So you ought to be able to do this in your calculator. Again, make sure that you hit second begin, then second set, enter, to make sure that it's a beginning annuity and it has that little BGN up there. And hit your n equals 5, I/y equals 6. Present value is what you're going to compute, so let's not do that yet. Payment is 25,000. What am I missing? Future value is 0. We have no future value, and you're going to hit compute present value, and that will pop 111,627. Okay. Now, let's look at a slightly strange type of annuity. Okay, so basically what I did was I just covered the nuts and bolts of the chapter. By far the most important 4 components: present value of a lump sum, the present value of an annuity, future value of a lump sum, future value of an annuity. Extremely important. You're going to need to know those. Because think about it. Just think for 1 second. Remember I told you that the value of any asset depends on its cash flows. And so since we're living in a world where there's interest rates, then the value of any asset is the present value of its future cash flows. So if you have a stock, for example, then you take the present value of all the dividends you expect. That's the value of the stock, because that's the cash flow the stock will pay. If you take the value of a bond pays off coupon interest. Take the present value of that coupon interest, and you have the value of your bond. Now, you got to get into the idiosyncrasies of stocks and bonds, and that's what later chapters are about. So we have entire chapters on how to value stocks and bonds later on. But it's nothing but an application of this Chapter 5, time value of money. So now, with a stock, keep in mind that a stock never matures, right? And there's also some bonds out there in the world that never mature. They're called perpetuities. A perpetuity is a constant stream of cash flow that goes into infinity. So let's assume we have a stock that pays a constant dividend forever, or a bond that pays a constant coupon forever. We're going to assume annual, like we have. And so we want to ask, what is the present value of that perpetuity? These are called perpetuities. Perpetuity. Stream of cash flows, constant cash flow. In other words, the cash flow doesn't grow out to infinity. It turns out that the present value, well, think about it. Before I tell you what the present value is, think about it for 1 second. You have this asset that gives you cash forever. It goes out to infinity. Should this be worth infinity? Should the present value of a stock that pays a constant payment forever be worth? It turns out not to be the answer. The present value is not infinity. It turns out that those future cash flows, say you get cash flow 50, 60, 70 years from now, which is nowhere near infinity, those cash flows, when you discount them back to today's value, those are future value amounts that you're getting, they're almost worthless. You're rewinding the snowball, and the snowball, by the time you're done rewinding it, it's the size of an electron or an atom. It's itty bitty. And so the cash flows, think about it. If you're going to get $100 100 years from now, what is it worth today? Well, that $100 that you're going to get 100 years from now is worth practically worthless. It's so little it won't even fit a penny. It won't even work with a penny, probably, depending on the interest rate. So you can do that calculation quite easily now that you know present value. So here, the formula is the payment for perpetuity divided by I. That's it. I's got to be in decimal form. And so an example of a perpetuity in terms of a bond is a British consul. In the UK, the UK has issued bonds that last forever in some cases. And so the value of the bond is not infinity, but the value of the bond, let's say the bond pays $25 per year forever. And let's say the world of the interest rate environment now is 4%. That means the bond is worth $625 today. The value of annuity. So what is $25 per year forever worth in an environment where interest rates stay constant at 4%? It's worth $625. So if you wanted to sell this bond, you'd be selling the bond for $625. Okay. Now, we have assumed annual compounding. And by far, it's the simplest way to do it. Interest rates are almost always on an annual basis. The interest rates that are disclosed, nominal interest rates, are almost always annualized. And so that's what I've been assuming, and your textbook assumes all the interest rates that I had in the previous problems, including right here, was an annual interest rate. But the world is a little more complicated than that. There are institutions that pay interest monthly, pay interest quarterly. There's loans and other assets that have interest payments that are quarterly, monthly. It's possible even to have daily. It's possible even to have an infinite number of time periods, or infinite compounding. We're not going to go into that, at least not here at this point. But that's called continuous compounding. So we need to understand the mechanism for dealing with the math for dealing with this interperiod compounding. So let's look at semi-annual and other compounding periods. And so here's the formula, basically, that you need to know. So I'll give it to you in a lump sum formulas here. So here we take the future value, okay, over n periods is going to equal present value times 1 plus I over m, all over n times m. Okay, so write that down. And by the way, you should be writing all of this down to help it solidify in your minds how this works. You, as I've been saying, you don't want to just watch this video. You got to write it down and keep up with me with pencil and paper. Okay, so what did we do here? Well, remember that the future value of a basic annuity was this on an annual basis. That was the annual basis. Now what I've done was I've chopped this I into pieces, m pieces. That's what I'm doing. I'm chopping the I into m pieces, and I'm multiplying the number of years by m pieces. M is the number of periods per year. It's the number of periods per year. So if it's quarterly, it's 4. If it's monthly, it's 12. If it's daily, it's 365. I think you get it. So what we're doing is we're chopping the interest rate into a periodic rate, sometimes called a periodic rate, this whole term right here. And then if we chop it, say, into 4 pieces, put m equals 4, then we have to say we have 4 compounding periods. So it's 1 year equals 4 compounding periods. So you're taking this to the 4th power. Okay. Let me give you some examples how to work this. Let's say you have a $5,000 balance on your credit card. $5,000 balance. Okay, your credit card. That's what it's worth today. That's a present value. And it's going to take a little while for you to get comfortable with these ideas of what is a present value, what's a future value. You're going to look at problems, you're going to scratch your head, and you're not going to know what they are. It takes some experience to get used to what is a present value or future value. But if I say currently you have a credit card balance of $5,000, that word currently signals that that's today, and so you have a present value. Okay. Now, it has a stated interest rate. And by the way, this interest rate here is often called a stated interest rate. This I is often called the stated interest rate. Sometimes it's called the APR, the annual percentage rate. And so the formula I'm showing you is consistent with the way credit card companies are required to compute interest. Okay, they can't compute it, and there's a whole bunch of different ways and assumptions that you can make, but they got to calculate it somehow, some way related to this formula. So again, back to the problem. You currently have $5,000 in your credit card balance, stated interest of 18%. Okay, your I/Y, that's your annual percentage rate. That's the interest rate that credit cards advertise. Read the fine print. They call them APRs, annual percentage rate. It's an annual interest rate. Okay. Now, assuming that you make no payments for the first year, what will be your balance at the end of the year if interest is compounded annually, semi-annually, quarterly, and daily? Okay. So let's take a look at it. So we're going to take the 5,000 and we're going to grow it by 1 plus the 18. That's the annual percentage rate. 18% in decimal form, divided by 1. So this is annual. And taking it 1 year compounded by 1 period gives you $5,900. So that basically transmits into $900 in interest income that you're going to pay for that $5,000. Now that's if they compound annually. But I can tell you, there's no credit cards out there that compound annually. They want to zap you for as much as they can. So they jack this interest rate up as high as the law will allow them and compound it out as much as they possibly can to rake you over the coals. So let's say quarterly, and I don't think there's very many that are quarterly, but let's just do the calculation. So it's 1 plus the 18 divided by 4. So this interest rate, this rate right here, this periodic rate, 18 divided by 4, that's 4.5% per quarter is what it's saying, right? It's 4.5%. And then it's 1 year times 4 periods. So this is $5,940.50. If you did it monthly, so you have monthly somewhere. I'll do the calculation monthly. Which is more appropriate, more common, I should say, in the credit card world. You're going to chop that interest rate into 1.5% per month, but you're going to compound it over 12 months. Okay, 1.05. You're going to get, it's going to cost you another, compared to annual, it's going to cost you another $78.09 a year by that monthly compounding. And if you did it daily, it would go up a bit more, but most of the compounding effects take place within the first, if you compound monthly to the 12th power. Once you compound, say, to the 24th power, to the 30th power, to the 40th power, you don't get much of an increase. So you got a $40 increase, and then you got less than a $40, you got $38. It dies out fairly quickly. So typically monthly is where it goes to. Okay. Now, so that's the math, for example, for a credit card. Now let's look at being able to compare interest rates. And use the terminology. What we want to do is focus in on these guys right here. Focus in on this stuff. That's the interest rate. Get rid of the balances, and that's where we're going here. Let's look at comparing interest rates. So let's look at what's called the effective annual rate. Sometimes it's EFF, or effective annual rate, year. And that is calculated by taking 1 plus the I to the M period, right? And then there's implicitly a 1 because we're looking at an annual basis. That means the 1, right? There's the 1 right here. All right, there's the 1 times M. Subtract 1 out because we added this 1. We got to subtract this 1. And that's the effective annual interest rate. So on a quarterly basis, in the problem we just saw, what was the effective interest rate of this problem right here? It wasn't 18%. It was not the effective rate. 18% is if the effective rate if you compounded only once a year. What was that interest rate? Right? It's not 18%. Let's calculate it. 18 divided by 4 to the 4th power minus 1 gives me 0.1952. Okay, so the interest rate that's embedded in here in this calculation is not the 18%, because 18% gets you to a balance that you owe of $5,900. Here you owe $5,940. It's really 19.5%, a little over 19.5% interest rate. And if you wanted to do this on an annual basis, you would come up with not as much as you think, as I was telling you before. You'd come up with about 19.7% is the effective, the actual interest rate that you were paying. But so remember, the law states that the APR has a limit in many cases around 18%, and the credit card company is right up against that. But in most cases that I know of, there's no limit on how much you can compound. So really, the 18% is really close to 20% in some cases. It's 19.5%ish, somewhere around there. Okay, now let's do an example. Assume you borrow $1,000 from a credit card company today with an APR of 18% compounded monthly. So the present value is 1,000. I slash Y, which is the same as I here, it's the annual percentage rate, is 18%. Okay. Assume that you don't make any payments. What would be your balance after 3 years? Okay, what would be your balance after 3 years? Well, put that into the formula. Here's your 1,000. 1 plus 0.18 divided by 12. We have monthly payments. Okay, let's assume monthly compounding. So it's going to be n years times 12, right? And this n equals 3 years. So the number of compounding, the number of months in 3-year period is 36. That's what that's telling you right here on this exponent. It's 36. So that's the same as saying 1,000 times 1.1956. That would be compounding on a monthly basis. That would be the interest rate, right? Times 1.1956. That's the effective annual rate on a monthly basis. Okay, that's 1 plus 0.18 to the 12th power here, and you keep doing that for the for 3 years. Oops, I'll just do it out. When we're done, we have 1709 and 9 cents, which is the same here as 1709. I got 14 cents. It's due to rounding. I just have rounding, so you compound things. You get some rounding. I'm not worried about when you're looking at $1,700 and you're off by 6 cents, nickel, doesn't matter. So you got to use your judgment there. There's rounding, and especially when you truncate numbers and you're compounding out 20 or 30 years, that truncation, it gets compounded for 20 or 30 years. Just be aware of that. And so you don't want to truncate too much, because then you get an answer that's pretty sloppy. So there's the answer to the problem. Again, the problem was, assume you borrow $1,000 from a credit card company with an APR of 18%, monthly compounding. Okay, you don't make any payments, so payments are basically 0. N equals 3. How much do you owe at the end? Well, you're going to owe $1,709. You're going to owe it's going to accumulate $709 in interest over that time period. Okay. Now, the last thing that we want to cover in this chapter, in this video, is amortized loans. Extremely important. Extremely important because mortgages, auto loans, student loans, bank loans, some bank loans, and other assorted, we sometimes call them in finance, credit instruments, meaning fixed income type securities, are amortizing loans. So we need to know what that means. Well, an amortizing loan means that when you make payments, not only are you paying for the interest, like I've been showing you in some cases, but also principal. So your payments are composed of principal plus interest. So when you make a mortgage payment, or your parents make a mortgage payment, Typically what's happening is they're making a payment towards principal to reduce their principal, and they're also paying off the interest for the month. And so amortizing loans are good because it reduces good from the bank's perspective. It reduces the risk of default, because if you're continuously paying off, say you get a $200,000 mortgage, if you're continuously paying off the principal, you don't have a lump sum due of $200,000 in principal 30 years from now. So when you're amortizing loans, the principal gets paid down along with interest. So the bank always gets its interest, but it's also getting a piece of the principal. And so that principal reduces to the point of zero at the end of the mortgage. So you're at the end of the line on the mortgage. There's no balance left to compute interest. So you have basically very, very little interest expense at the end of the 30 years. The interest expense is huge up front in the first few payments because your balance is huge. So what we want to do is we want to put together a amortized loan schedule is really what we're doing here. And sometimes if you took an accounting course, you might have seen something like this, because in accounting you're interested in let me see if I can put that somewhere here. Sometimes in a accounting course, here's your balance sheet. If a company's lent money, it has assets, liabilities, and equity. It wants to be able to put down on its liabilities the present value of their loans. What is the present value of the money that they owe? Or even in this case, the present value. If they lent money, it's an asset. If they owe money, it's a liability. But in either case, you got to book and put on the books the present value. So that's an application from accounting. But here we're interested in the financial concepts and how all this works. So let me give you an example, and we'll actually do a table. Okay, here's the example. You're going to borrow $100,000. Okay, 5 years. N is 5. Right, 10% mortgage, 10% interest rate. And this is going to be annual now. It's just too, I'll steer away and go to annual as much as I can so that you get the intuition. What happens is if you go monthly, like the real world, you lose the intuition by getting tangled up in the math. And so I'm going to shove aside that real world implication and do the calculations on an annual basis so it's clean and you get the intuition of how these mortgages are working. And other securities, by the way, other things, other loans. Okay, so again, this is you borrow $100,000 for 5 years at 10%. The payment schedule calls for equal payments at the end of each period. So we know it's an ordinary type annuity. Payments are at the end of each period. Interest is computed based on the beginning of the year. So the dollar amount of interest. So I'll put a dollar. Dollar amount of interest that's due is computed at the beginning of the year principal. Dollar interest is computed from beginning balance. That's important to know. So it's the balance at the beginning of the period that is used to calculate the interest that's due. And so you can calculate the payments. So the first thing is, what the heck are your monthly payment or your annual payments? That's what you need to know first off in order to build this schedule. I'll show you 2 ways. I'm going to show you mathematically and then how to bang it out on your calculator. So we are looking at this $100,000 is what you're borrowing. That's a present value. So we're going to look at this formula. Present value equals payment. Oops, it's a minus. Here's the formula that I showed you for the present value of an annuity right here. Plug the numbers in and we're going to solve for payment. So this is $100,000. This is 10% for 5 periods over 0.10. And then, so this whole thing, when you solve, payment equals, oh, this whole thing in brackets is 3.791, by the way. Payment equals 26,379.75. These you just solve for payment mathematically. That's not too bad. On your calculator, let's confirm it, because when it comes to a test, you have the ability to use this formula, which didn't take me more than a couple seconds to calculate, right? Then you can back it up on your calculator. Because let me tell you, and you already know this, but when you start banging numbers into your calculator, numbers start flying out and you're looking at them and you don't have context for it, you don't know if the answer is right or wrong, or, you know, am I far off? So you should have a way to back up and verify your answers. This math that I just showed you does that. But you want to confirm that sometimes your math by hand will give you, it's easy to make a mistake. Easy. So confirm with the calculator. So I/Y is 10. N is 5 years. The present value is, and we could put it in as if we put it in as negative 100,000, the payments will come out positive. If you put this as positive, the payments will come out negative, and you'll be able to interpret it. The future value is 0 because I haven't given you anything. It's not part of the problem. You're going to compute payment. When you do that, out will pop 26,379.75. Okay, that's great. 2 different ways to compute it. Now we want to go one step further and get the intuition as to what's going on underlying this in terms of principal and interest. So what you're going to see is that your interest expense, even though the payments are fixed in the mortgage, and in this example the payments are going to be fixed at $26,379 each year for 5 years, the amount that's allocated to interest and the amount that's allocated to principal will vary. The principal balance will start going up because the interest will drop. So your payment, this payment here, is made up of principal and interest. And over time, since your balance overall drops, your interest expense drops, which means each payment contributes more and more to principal, which is exactly why, and it's extremely important for you to realize that if you can double up early on your principal payments in a mortgage, so when you first start out at a 30-year mortgage, the principal payments are really small. It's almost all interest. All you got to do is, if your mortgage bill is $2,000 a month, all you need to do is make a $2,100 a month payment, for example, or maybe a $2,025 payment, and you will have basically doubled the principal that you're paying, because the principal is very small. It could be $125 or whatever. And so if you double up on the principal, you'll pay your loan off so much faster and save yourself hundreds of thousands of dollars in interest expense by doing that. By that little tip, double up, triple up if you can on the principal payments early. And in the state of Maine, you're allowed to make those principal payments. You're allowed to pay down your mortgage early. So nobody, I shouldn't say nobody, very few people hold a mortgage for 30 years. In fact, we look at 10-year interest rates in this class, in my economics class, in my investment class, my derivatives class. We look at 10-year interest rates, treasury rates, as a benchmark rate in a lot of applications. And why do we look at the 10-year rate? Because interest rates for mortgages are based off of 10-year treasuries. Why 10 years? Because a 30-year mortgage never lasts 30 years on average. Most people pay down or either sell their house or pay down their mortgage early, and so the average mortgage lasts about 10 years, which is why they look at 10-year bonds to price mortgages. Okay, enough of that. Let's actually put together a table. So I'm going to build a table, and I'm going to have year at the top. I am going to have beginning, balance. I'm going to have payment. I'm going to have interest payments, and then I'm going to have repay, and that's the repayment of principal. And then I'm going to have an ending balance. I'm running out of room here. Okay, so we're going to start out 1, 2, 3, 4, 5 periods. So I'm going to build this table. The very first number that goes in is at the beginning of year 1. You can draw a timeline out if you want. The beginning of year 1, the balance is $100,000. That's the present value. And we just computed the payments. $26,379.75 for year 1, year 2, year 3, year 4, and year 5. We just calculated that. That's easy. Now, the interest expense, I told you how to calculate the interest. Take the beginning balance, multiply it by the interest rate. So take $100,000, multiply it by the 10% interest rate, and the interest for the first year is $10,000 in interest expense for this. Now, this is a very short mortgage. It's only 5 years. So when it's a short mortgage for 5 years, you're going to have to be paying this principal back pretty quickly. So the principal payments will be pretty big on a 5-year mortgage. A 30-year, the principal payments will be small. So how much are you paying back in principal? The difference. If your payment is $26,000 and you paid $10,000 in interest, that means $16,379.75 has to have gone to pay back principal. So your ending balance is now this $100,000 minus the 16. Your ending balance is $83,620.25. Carry that guy right up over to $83,620.25. You still have the same payment of $26,379. Interest now is a function of your beginning balance times 10%. So it's 10% times the 83,000, 8,362.03, which means if you made a $26,000 payment and interest was $8,300, the difference between these two numbers had to be $18,017.73 pays back the principal. So your ending balance now, subtract this $18,000 off, $65,602. I have 50, I'm thinking of 52. Could be a 32. I think it's a 52. Okay, that's your beginning balance for the next year. So your ending balance is your beginning balance for the year later. 52. Multiply that by 10%. That's your interest expense. That's $65,660.25. The difference between your 26 and your 6,000 is 19,819.50. And so your ending balance, subtract that 19,000 off, 45,783.02. And I'll finish the rest, but you ought to be able to do this on your own. In fact, I'll just put this as 45,783.02, and then this becomes 23,981.57. Okay, and when you're all said and done, if you've done this correctly, so I've given you hints on how to finish the rest of it right here, this number has to be 0. So you basically, when you build this table, you know the answer has to be, this number better be 0, and in English that means you've paid off the mortgage and you owe nothing. So you have an ending balance of 0 after 5 years. Okay. Now, one other little trick here is what happens if this was an annuity due? What is the mortgage where your first payment was due today rather than 1 year from now? So I'll just give you the basic math on that. So present value of annuity due equals the present value of an annuity, and that's after n years. This is n minus 1 for ordinary plus the payment. So mathematically, the present value stays the same. You still owe $100,000 at the beginning, but you need to calculate this number. So really what you're doing is you're solving for payment. So you got one equation with one unknown. And so this whole thing turns out to be 3.17 here. And solve for payment. Payment turns out to be 23,981.59. Which is less than the 26,000 we were dealing with up here earlier, right? Why? Because if you can talk your bank or your mortgage company, you probably won't be able to do this, but if you could talk them into making your payments at the beginning of the period rather than at the end of each month, or at the end of each year in this case, you can save yourself some money, like I've been telling you. Make your payment. If you make your payments early, the payments will actually be less because you won't have to be paying all that interest expense on the balance for that by delaying for one period. So you can calculate this on your calculator. Go to second begin, second set, put in an interest rate of 10%, n equals 5, present value of 100,000, future value 0, compute payment, and you'll get 23,981.59. So that concludes this video on time value of money, and I've basically given you all, I think, nearly everything you need to know for time value of money. Now what I'll do in the next videos is I'll supply you with some problems that can be quite complex. The world of time value, time value of money and finance, it can be quite complex, but if you understand these calculations, understand them, don't try to memorize it, understand what's going on here, you'll have the tools you need to answer those more complex problems. Because I'm telling you, the problems will become more complex and it'll be almost impossible to understand them if you just memorize what's going on. Because the context of the problems change from problem to problem. The wording will be different. And that's the world. The world's problems are set out and laid out, different types of languages. You need to translate that into exactly what I'm showing you in this video. Translate it, and then you'll be able to come up with the solutions. It will take a bit of studying, so you want to put your time up front early. As they say, the pun is invest early in this, and you'll reap rewards. Because eventually, at the first week or two, you may not understand this material, but if you work at it, it'll sink in, and then it'll click. Something will click somewhere along the way, and most of what I'm saying will make sense, and then a little bit of studying here and there, patch up the places you're a little off on, and you'll be okay. But you wait for that point to click, and you'll be in good shape.